it's Neil here, back again for another part of decentralization and transfer pricing, but we're getting into the mechanics now. The previous sections really focused on the big picture, the overview, the trade-offs, the strategies, but now we're looking at transfer pricing, and we really want to get into the mechanics of transfer pricing. Why do we do it? How do we do it? What are our options? Let's start with the purposes of transfer pricing. The purpose is to provide an economic signal to the different divisions that are involved in the transfer of some economic value, whether it's a transfer of goods, transfer of service, transfer of components that go into the goods that are assembled into the other division. Okay, and it's to provide information for evaluating PC performance, so profit center performance, or to purposely move profits. You know that in international taxation, to move profits between a company's entities and locations. Yes, to move profits out of China into Hong Kong, for example. Why? Because China's tax rate is here and Hong Kong's tax rate is down here. Okay, you've got the different incentives, and just that's a brief overview of some of the purposes of transfer pricing. Let's have a look at it in a little bit more detail. So we want to have some form of gauging the performance of different divisions in a decentralized environment. We want to have some way of gauging. So accurate performance information, transfer pricing can help with accurate performance evaluation. Now, we also may want to use transfer pricing to help achieve some form of goal congruence. That is, the divisions don't work against each other, they actually work together. They work together in terms of they're all in one for all for one for all for the company as a whole. So the division in Melbourne does not handicap the division in Sydney. When a Sydney customer goes down to Melbourne and looks for the same service, the division in Melbourne treats that customer as if it's part of the company, even though they're not a core profit generating customer for the Melbourne office. They're really there for the Sydney office. You know what I mean here. All right, so we want divisions to cooperate. And that's what we mean by goal congruence. And also we want to preserve divisional autonomy. So we've given divisions opportunity to grow and to make decisions, not have to refer to head office all the time, not have to refer to one another all the time. So we try to keep that decentralized environment working for the benefit of the organization to maximize how our management of the knowledge transfer costs. Yes, so we want to try and get some accurate measure of performance valuation. We want to try and get divisions to work with each other, but at the same time we want divisions to feel as though they have some autonomy. So we try and use an opportunity cost approach in dictating the minimum transfer price required, and that approach is to identify the minimum transfer price and the maximum transfer price. So let's have a look at what we mean by how we might apply these different rationales of using transfer pricing. So as I said earlier, we've got it achieves goal congruence, motivates managerial effort, used for evaluating subunit performance, preserves subunit autonomy, and there may be other factors, but what I've said previously was 3 factors. Now we've got 4, but we're really breaking apart the second one. That is evaluating subunit performance. We're breaking it up into motivating managerial effort. Okay, the reason why you evaluate someone is partly for motivation purposes. All right, and we want to evaluate performance. It's one of those legs of the 3-legged stool. So we've got 4 different objectives here: goal congruence, motivating effort, evaluating performance, preserving subunit autonomy. Okay, and there are different types of transfer prices: market-based, cost-based, and negotiated. Now, it's very easy if we're in a very very transparent environment where the goods being transferred have a market outside the organization. So then you can refer to that market and use that as the transfer price. But that is not always the case in most organizations. And maybe what's been transferred is a component that has a special design, so it doesn't have a market equivalent outside. Or there may be some proprietary information that you are transferring, part of a service that goes part with a product. that's packaged into a total product and service offering. And so there may not be a separate market out there to refer to. So in that case, you may use a cost-based or a negotiated-based transfer price instead. And so whether you use a market-based, cost-based, or negotiated, then they're going to appeal to these different purposes in different ways. Market-based is the easiest and best to use. It's going to say yes, 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 and everything, because there is less judgment involved. You're not dealing with unfairness of favoring one division over another. It's just the market, right? And that's just the way it is. And everyone seems like, well, it's a competitive market and this is the way it goes. And so no one's going to fight over it. And it's automatically, it's like an external reference for that price. But things get a little bit more tricky when you use cost-based prices or negotiated-based prices. They don't always achieve all of these objectives at the same time. So for example, in motivating managerial effort, cost-based prices can work if it's based on budgeted costs. So then you've got to work out what is a reasonably budgeted cost. Do you have enough information to set a good budget? Are you using prior year's budget? What about future year's budget? Has the prior year's budget got inefficiencies in it that you may want to improve? So therefore your current year's budget is going to be different. So you need to do more work on the budgeting to use cost base. For evaluating performance, it's difficult unless the transfer price exceeds the full cost. Even then, it's somewhat arbitrary. All right. What about cost base? Does it preserve subunit autonomy? No, because it's rule-based. In other words, it's sort of like a top-down. This is the transfer price that you need to use. It's your cost plus a certain percentage. There's a rule there, and divisions don't have autonomy to decide what the value of that transfer is. So as you can see, cost base does achieve some objectives but doesn't achieve other objectives. What about negotiated transfer pricing? That's likely to achieve some more objectives. Yes, it can achieve goal congruence because you get two divisions, Melbourne and Sydney, talking to each other. It can motivate managerial effort because they've got to go into negotiations. They've got to fight for the value that they are transferring or fight for the value that they are paying for. So it actually gets motivation going. And it's useful for evaluating subunit performance. Yes, but it's affected by the bargaining strength. If one division is stronger than the other, then they may win greater margin in that transfer price that benefits one division, and it leaves the other division that is weaker in terms of bargaining power. They may not have as much options, and so their subunit performance looks worse just because their bargaining power is weaker. So you've got to be careful about that. And negotiated transfer pricing does help preserve subunit autonomy because it's based on negotiations. I'm the head office. Don't come to me. You work it out yourself, right? Okay, you do negotiation yourself and then come back to me and work out what you have decided. Okay, so I'm not going to get involved. You guys are autonomous. It's a decentralized organization. Go and negotiate. So there you have. We have the different criteria in using transfer pricing, and we have the different types of transfer prices, and they don't always effectively achieve these purposes to the same extent. Let's get into some of the mechanics of calculating a transfer price. So the minimum transfer price should be incremental costs per unit incurred up to the point of transfer, normally variable costs, plus the opportunity cost per unit to the selling division. That is one definition. Another definition may be the variable costs plus the opportunity costs associated with loss contribution margin, especially if that division doesn't have excess capacity and has to forego sales externally in order to transfer those units internally. Okay, so based on this definition, variable costs plus lost opportunity costs or lost contribution margin opportunity, that is really dependent on whether the transferring division has capacity, has excess capacity, or is giving up external sales capacity. You with me here? So if they have excess capacity, then it's likely the minimum transfer price is a variable cost. If the division doesn't have excess capacity, it's going to be variable cost plus that lost contribution margin of doing that internal transfer. Let's have a look at an example, shall we? So we have a board division, games division. All right, let's go over this organization. So the board division, they make printed circuit boards. Then they are sent to the games division and they're assembled together to make PlayStation or to make an Xbox. You can see that two divisions in a big organization. Call it Sony or Microsoft, what have you. All right, now the board division can actually sell. They can sell the boards outside. What can they sell it for? They could sell it outside for the selling price. They could sell for $22. So they could sell it outside for $22. If the games division, if they wanted to buy it from outside, they would have to pay $22. Okay, now, are there any avoidable distribution costs to the board division from doing the internal transfer? Maybe there is, maybe there isn't. Yes, there is. $2 in selling costs. Let's mark that up, shall we? Avoidable distribution costs of $2. Now, what does that mean? If board division transfers printed circuit boards internally to games division, they can avoid $2 in selling costs. So effectively, the board division, by selling internally, the equivalent sale price would be $20 and not $22. Can you see that? Because they avoid that selling cost. That is, transporting those boards to an external customer, serving the external customer, giving after-sales service support, etc. You got that, all right? So we start to get a feel for some range of transfer pricing. At the maximum, board division would like to receive, say, $20. Maybe they'd like to receive $22, okay? All right. Now, what is the minimum they would receive? Well, it could range from just $12. $12 could be the minimum. But that's if board division has excess capacity, you see. If board division doesn't have excess capacity, in other words, if they transfer printed circuit boards internally, they have to give up external sales, then that giving up of contribution margin is going to be $8. How do we work that out? Well, it's $22 less the $14 here. 12 and 2, $14. So variable costs is $12 and the contribution margin is what? $8. That is the minimum transfer price. 12 plus 8 is what? $20. So the minimum transfer price, if board division does not have excess capacity, is $20. If board division has excess capacity for all these units, then you can move the transfer price down to just $12. You can see that, can't you? All right, so let's have a look at some of the options that we have here. So one comparison is the external market printed circuit boards at $22. So board division is selling to games division for $22, and there we have the operating income of board division, games division, and the total $900,000. So the actual cost of goods sold is $3,120. Games division is actually buying that $2,912, and that's part of the sales. Sorry, games division is actually buying the boards from board division, and that will be registered in here. The board division transfer in the games division will be registered here as a sale, and so that sale becomes a cost of goods to the games division. You can see that transfer going on, and that's at $22, and that's normal for external market, and that's at $22. Now, what if board division decides we're going to sell these units at $21.10? So you can see that what we're making the assumption now that board division does not have excess capacity. Okay, so board division, the maximum it can sell it to games division is going to be $22. Games division do not want to sell for more than $22, but board division do not want to sell the unit for less than $20. So the range, the minimum and maximum transfer price is $22. The minimum is $20. $20 is the variable cost plus the lost contribution margin, right? You got that? The maximum is the external market purchase price that games division would have to purchase for, which is $22. So you have $22, you have $20. So here is an example of income statements where $21.10. So what's going on? Games division is actually saving 90 cents. Because if they go external, they got to pay $22. Now they have to pay $21.10. What about the board division? Well, they save $2. They save $2, but they're actually given 90 cents away of that $2. So board division is actually taking $1.10 saving out of that $2 selling cost saved. So there's $2 in selling costs saved by making that internal transfer, and games division is getting 90 cent share of that. Board division is getting $1.10 share of that. So that's avoidable distribution costs. We have avoided $2 in distribution costs. In the next example, we're going to look at excess capacity. What if we have excess capacity? The previous example said we didn't have excess capacity. So the actual minimum transfer price is the variable cost plus lost contribution margin. That was $12 plus the $8. Now we have excess capacity. What's the situation here? Well, we have a pharmaceutical division that would like to buy 250,000 bottles from the plastics division. So plastics is actually supplying pharmaceuticals division 250,000 bottles. Now we can do that transfer at 40 cents per bottle because plastics have lots of excess capacity. All right, so what happens here? Plastics division at 40 cents is going to make a sale. How many bottles? 250,000 times 40 cents, that's $100,000. So 40 cents, the $100,000 of sales of plastics division goes into some of the expenses of pharmaceuticals. Yes. Okay. Now, at 25 cents, plastics division only gets $62,500, and pharmaceuticals division starts to get a saving of that amount in lower variable expenses. Now just note that the pharmaceutical division has a 60-cent variable cost here. All right, we're just looking at the transfer price of 40 cents and 25 cents here. All right, so we can do a transfer price of 40 cents. We can do a transfer price of 25 cents. Both divisions are happy because pharmaceuticals is saving money. Plastics is actually still making money. Then we can go down to a transfer price of 20 cents. Is plastics division still making money? Yes, they are. Pharmaceuticals is actually saving even more. All right, there's that 20 cents transfer. Or we can go down to 15 cents. And guess what? Plastics division is now not making any money whatsoever. Pharmaceuticals division is getting the full benefit and is basically paying cost for those plastic bottles of 15 cents per item for 250,000 plastic bottles. So you can see that for excess capacity, we can drive down that transfer price until the actual transferring division actually earns next to zero, okay? But the company as a whole is still better off. And so these are different scenarios where you have excess capacity. The minimum transfer price is the variable cost of the transferring unit. In this case, the minimum transfer price is 0.15, 15 cents per unit. Anything above that, then the plastics division is going to make some money. Yes. So there you have two examples of transfer pricing. One is we can avoid external selling administration costs at $2, right? And the second example was when we have excess capacity and the minimum transfer price was really right rock bottom down to the variable costs of the transferring unit. So think about that. The general transfer pricing formula, the maximum is the external selling price. The minimum is when there's no excess capacity, it's the variable cost plus lost contribution margin. So in the first example, it was $12 variable cost plus $8 lost contribution margin, so it's $20. In the second example, the minimum transfer price was the variable cost only because the plastics division had excess capacity. There was no lost contribution margin opportunity cost, so to speak. So keep those two examples in mind. The formula stays the same. It's all about working out what is the maximum, what is the minimum transfer price between two units working together. Okay, I'll catch you in the next session, but this is really good mechanics and great introduction to how transfer pricing can work between two divisions, working through two scenarios under having no excess capacity and having excess capacity. Catch you in the next session. Bye for now. Thank you.